Good morning, guys. Welcome back to another episode of Capital and Context. As we promised last week, we're probably, perhaps going to do our most technical session to date. We've sort of tried to do quite rounded sections so far with a bit of education and opinion and stuff. But this week we're going to try and get into Sam's mind, which can be a very dangerous place.
It's scary.
But in the context of the actual portfolio trades that Sam has put through across his various portfolios over the last sort of week, 10 days. So I think this will be nice to have a really focused episode on what those have been and why. And, probably, Sam, for the viewers, it would be good to sort of give a view of when you perhaps make a short-term portfolio trade, something that's reactionary to what's going on in the world, to something that you're probably going to put in the portfolios and maybe have there for a much longer period. And again, maybe how that changes your decision-making process. So apologies, I'm on the back end of a cold, so apologies if I'm coming across a little bit nasally here. But we're here and active, which is the main thing, really. So. Yeah, the trigger for these trades obviously has been the conflict that we've been speaking about in the last couple of weeks. And rather than going through your very well prepared paper, I think trade one sort of sits in the corporate bond space. Something we've done a session on, something we've spoke very highly of this fund. But again, I think is an interesting one to start on also knowing when to come out of something that's done very well for you. So I think that's the Man Sterling Corporate Bond Fund was your first trade. So yeah, over to you, and I'll prompt and probe where needed.
So yeah, thanks. So I think one of the things that's interesting when looking at this is it was possibly a fund that we were looking at reducing anyway in advance. So that's the first thing I think goes through your mind when you enter one of these volatile environments, is it that you immediately go, okay, what was already on our watch list for possible trades, and review those to see if it's a trading environment for them. The reason why we chose to reduce the weighting in this is, although it is normally labeled as a investment grade fund, which it is, the majority of it is an investment grade sterling corporate bond fund, it does have a degree of higher non-investment grade. So when I say higher, I mean higher yielding non-investment grade holdings within it. And don't get me wrong, that's worked very well over the last few years. The fund manager, Jonathan Gerlin, has been very good at identifying holdings that will get re-rated up into investment grade. Okay. The problem is, though, is it does mean with that element there of non-investment grade, is you do end up being vulnerable to widening credit spreads when there's a bit of a risk-off sentiment. Tends to outperform over more medium terms, but in shorter periods it's a bit more tricky. And where we came from at the beginning of this year anyway, with credit spreads being very tight indeed, it just seemed like a time to possibly take a little bit of that success out from our portfolios and reallocate.
Okay, and if I start at the sort of lowest risk portfolio one, what sort of change have you made there, and how's that progressed as we go through up to a portfolio 4 or 5?
Yeah, so 4 or 5.
Well, let's start at 1.
I was going to go from smallest. Okay. So 5 doesn't hold it.
Okay.
But other end of the scale, portfolio 1, it's the largest holding within the portfolio. Yep. So we ended up selling out 7% of that holding. So when I say 7%, I mean 7% of the whole portfolio weighting, rather than just that one position.
And that's an RP portfolio. We can't do that now, right?
No, because it's an active holding. Don't get me wrong, this is definitely got to be careful what I say here, but this is definitely an active fund position which we can't hold in that has added value to the portfolio over the last few years. So yeah, we've taken 7% of portfolio weight out from that position, which is quite a bit to do in one go.
Sizable.
I quite like where we've put it though. I don't know if you've got questions to go first before I go on to that.
So 7 there, nothing in 5. So we still holding sort of 3% or so in, holding more. But what did you change in? What would have been the sort of portfolio 3 reduction?
portfolio free would have been around about what you said,
About
around
3%,
about 3% reduction. The where we moved on to though was, admittedly, it's another man fund. I don't know why I say admittedly, like as if it's some kind of secret. It's actually, as we've said in the past, a fund manager that we've always quite liked working with, Mike Scott, not from The Office. I'm sure he's had that joke thrown at him many times over the years. Poor guy. So it's actually demand credit alternative opportunities. So this is a long short play on the credit market. So actually in this environment, it's done exactly what it says on the tin.
Okay.
So whilst just looking at my notes right in front of me, unfortunately the notes, here we go. So through to 2 days ago, Man Sterling corporate credit was down 2.57% from pre-war. Man credit alternative opportunities is down just 0.35%.
Okay.
So, that's over a 2% difference in performance from this one fund. So it really shows how long shorts definitely have their value. And the great thing is as well is that eventually when it occurs, there will obviously be a rally, whether it's for whatever reasons. It might not necessarily be due to Iran winding down, but there will at some point be another rally. This will participate as well on the upside. Not as much, but it will still participate. So it's not a case of, you win on one side, you lose on the other side in nominal performance terms. You will still participate. Yeah. So,
How do conversations go when you're, obviously you're not telling them, perhaps in meetings, that you're moving from one man fund to another, or is there a sort of more independent man person that you go to perhaps also tap their views between those two funds, or would you say that's just something you've delved as a strategy yourself and not something you can really push too hard for at Man? Do you think there's rationale in what I'm doing? Or
it's a tricky one. So majority it is independent. It is are you using our discussions and so on and so forth. There is a degree of, before I go down this track, of I will have a discussion with my contacts, not necessarily the fund managers, but one step higher, our business development manager contact, and kind of get scope of to what are the conversations that our peers are having. Just like trying to scope out, it's like, actually, is there something someone else has mentioned that I haven't noticed, that kind of thing, and then try to get out a little bit of their views. Don't get me wrong, they're business development managers, so ultimately they're going to have a sales spin on it. But so you've got to bear that in mind. But it's in our interest to tell them when there's a sell down occurring and why. Ultimately, we are very fortunate in the access that we get to fund managers. Some of the access that we get, frankly, is like we should have if we had many more multiples of AUM.
Yeah.
And a lot of that is just due to how we've managed those relationships over the years. So that's something that keep going.
And we're growing.
Pardon?
And we're growing.
Oh, and we certainly have grown. Yeah. That's something that is definitely, I've been noticing certain things opening up over the last 6-ish months.
Yeah. One thing, I'm going to sound very compliancy, is that other episodes we haven't probably spoken quite so much about direct ideas and things like that. So as I know this is going to a public audience, I will just also stress that these are in no way pieces of advice for people to go and apply or anything like that off the back of that. And any of these ideas you might like, please come and talk to myself or one of our advisors directly. So yes, just a little compliance note in this podcast there. We are talking about quite direct ideas and things here. So these should just be treated as such and not any form of advice to go and execute these things. So thank you. Back to the very interesting conversations and ideas we've got here. So if you've got idea 2 there, Sam, please do feel free.
Is that roughly translated as you haven't turned to that page yet?
No. You've done the gilt, you've done the fidelity gilt.
We haven't done.
No, just in general. So let's go to fidelity. Let's go to fidelity gilt. again, this I think one of the things we perhaps don't sell well enough is there's so many times when people manage portfolios, and I think this was my biggest bugbear with not having a separate investment business to a financial advisory business, how equity focused and things people are in their discussions with clients and things like that, and that was always something I set about wanting to do differently. So yeah, not again blowing smoke off our but I think again it's good that you can clearly see that we and I think you always say this about yourself, you are like very interested in the debt space, the fixed income space, and knowing that there is client money in these portfolio 1s, portfolio 2s, portfolio 3s, probably the least in portfolio 5, the all equity portfolio, yet people talk about equity markets so much more than bond markets. So yeah, leading on to the next one, the Fidelity UK gilt position that you've altered.
Yeah, I think the other thing as well that's important off of that is how many people in the advisory space don't necessarily communicate with their clients about actually one of the huge drivers behind equity performance is actually the bond market.
Yeah.
So it's such an important part. Anyway, so yeah, Fidelity UK Gilt Index funds, which when you talk going down the line of index funds, you're very much talking along the lines of what index is it tracking, and obviously, and then in essence it comes down to a cost game ultimately. So this is the one that tracks the index that we want at best market pricing, and also offers the liquidity we want as well. That's an important part behind what our job. So this tracks the overall gilt index, as you'd expect, which has a duration of 8.5 years. So that means if you held the index and you did nothing at all with it, you just left it, in 8.5 years, you would basically get your capital back, in essence. The longer the duration, basically, the more sensitive it is to interest rates. We see quite an issue upcoming in the euro and gilt space. Obviously, inflation is going to be a big talking point, but the other problem is it was interesting. There was a news article about this yesterday saying Rachel Reeves has disclosed the criteria for this, or the kind of the themes, which is 2022 let the cat out of the bag with regards to state support on energy when energy's price tick up. Now, that isn't a zero-sum game. Someone's got to pay for it, and it's the taxpayer, or in this case, gilts. And that means that you end up paying more for gilts. So, as in, more interest that the taxpayer has to pay. Yep. So, those things are both negative from a gilt holding position. So, took the opportunity to make our holdings within that space a lot less sensitive and move it into money markets, which does have a very slight degree of duration, but largely operates almost similar
short
to
duration or money markets.
So it's short-term money market. Yeah. Okay. So yeah, it has a very slight duration, but by and large, forgoing any credit events is kind of a bit of a straight line.
Okay.
So long as interest rates don't change too much.
Yeah.
So that's
what would be a situation or a gilt level that we got to that would make you maybe reverse that? I think you referenced here gilts went back close to 5 or
actually nudged over.
Yeah. So is that something you're going to now be closely watching as to perhaps reversing this? Or
I think the problem that you've got is with regards to gilts, I think Eurobonds is a bit different, but with regards to gilts, I think we've got some upcoming political risk. We've got the local elections in May. You can't help but think Keir Starmer and Rachel Reeves being able to survive that is worse than a coin toss. And who would replace them? Lately, Angela Rayner's been doing the rounds again. She's had a couple of meetings in the city trying to shore up support, saying like, look, I realise things have to be paid for. It's not going to just be spend. But I don't know. Let's be honest, that kind of political upheaval just wouldn't be what we see. No. So I think it's something that actually I think gilts is it stays like that, and we review it in June.
Yeah. Okay. Anything equity based? What was anything equity based in these trades?
Yep. So
US smaller companies. Here you go.
yep, very much. So it's unfortunate because this was actually one of my favorite positions coming into this year. But we exited for T Rowe US smaller co's. Moved that into the S&P 500 large cap space. It's a space that is very sensitive on interest rate changes. So that's obviously a bit of a negative at the moment. Don't get me wrong. It was one of those things that, unfortunately, due to the way market volatility was at the time, was actually really difficult for us to trade OICs. We had to wait for it to quiet down a little bit, which was last week. And so, don't get me wrong, we could have exited it earlier, but you didn't know where the pricing was going to be by the time that trade actually went through. So moved that along just to an area that's a bit less interest rate sensitive. And not just that, one of the safe haven trades out of all of this, one of the few, it seems in relative terms, has actually been kind of like those Mag 7 tech, etc. spaces. It's been interesting. A lot of traditional plays that you would expect in this environment just have not been playing out. Don't get me wrong, there's been a degree of earning calls going in that space, which has helped support them. But, you've been looking at gold, I think yesterday was very nearly at 4,000.
Yeah.
When you think we were pre-conflicts like 5.2.
Yeah, everyone was telling us it was going to 6,000. So that was
people have been reaffirming that position. But that space is quite sensitive on interest rates. Don't get me wrong, the position that we held was less sensitive than the broad index in that space, and earnings growth in the US should be fairly good. So it's one to keep an eye out on. But I just think we just need to see how the consumer confidence plays out in the US first. Yeah. And then we might go back in.
Gold down again this morning. So yeah.
Yeah, it's just, we've had plenty of
conversations. We'll find a point for that. That was a really good conversation last year. There was lots of suggestions that why were we not holding it? And I think that goes back to, again, my age-old influence on the portfolios of preferring to try and buy stuff cheap, but at the same time, swallow in pride. So I think we went in with about 1.5%.
Yeah, it wasn't huge.
But yeah, I think we'd be, if we got back to 3, 5, 4.
Yeah, absolutely.
It could be something to
everyone
get that second shot, and that's how markets work. A lot of the time it's not being right the first time. It's often the second or third time that then the prolonged level holds. So yeah, interesting that
everyone's been reaffirming their year-end targets still of around about 6k.
Yeah.
So that's interesting. But I think at the moment, particularly in the mining space, gold's been selling off as well because there's been margin calls on everyone's futures contracts.
Yeah.
So there's been technical reasons behind the sell-off, but there's also been a difference in equity risk premium priced into the miners, which we hold, which, I'm glad that we put our trades through as a rebalance rather than an ad hoc thing.
Yeah.
So what that means for anyone listening is that the trades went through trying to bring everything back to the target weight. Obviously, as time goes on from the last rebalance, positions drift. And normally when we do our trades that, we trade the exact percentages of those positions that already moved across. Whereas if you put everything through as rebalance, it means that everything that's been sold off comes back up to target. And what that means is that, in theory, if there is a recovery, it's similar to how the sell-off has gone, you actually benefit far better than just doing an ad hoc switch. So that's why actually some people might have seen quite large changes in their portfolios, just because we're trying to bring everything back to the target that we felt was sensible and rational for more medium term.
Yeah, that's important. So these were the strategic overlays, but thanks for pointing and explaining that. Sam, everything also got a repositioning as well. I think we've done 3. So we haven't touched on Europe. I've been talking about Europe more in my client meetings. So now's time for you to reinforce if what I've been saying has been the right message to be delivering there. But I know that was something that was probably, I think, your most conviction trade of the lot, sort
Halved
of from the discussions. And yeah, let's give you the floor to where your mind is with that, and whether it obviously how it's playing out so far. It's very early. Obviously, I'm not too bothered about how it's playing out so far, but why you do think this is a rest of the year trade.
Yeah, absolutely. So I think that's the important thing to talk about with these trades is that we can't look at these trades on a 1 or 2 day performance difference. You've got to look at it over more medium term. And I think the key part about all of these trades, bar the US smaller co's, is they are trades that I think are correct for no matter what the outcome is, whether we're talking about it wrapping up tomorrow or whether we're talking about this going on for another 3-4 months. But this one is, it's quite a high conviction. It was a 50% cut in our US government debt holdings. If the inflation has already been set into motion on this. Even if the conflict ends tomorrow, the time it would take actually for oil to flow out from the Strait of Hormuz is around about 3 weeks in best case situation. And then the time it will take to get to Europe is obviously the transit time. You got to add on top of that probably another 3 weeks. So you got 6 weeks. Bear in mind the last flows of oil and gas have just arrived. So you've got 6 weeks of no deliveries. We've just come off of the end of for winter season, and so we're starting refill season now on storage of gas. We come off of a colder winter, so we've got the lowest storage that we've had in 4 or 5 years. That it was always a little bit like, oh, how are we going to get on with filling up gas? It'll just be a bit expensive. This time around, it's a genuine kind of like, actually, are we going to be able to top up those tanks enough? So there's genuinely not a great picture on inflation when it comes.
Sold
to
my car this week. I took your advice. My gas guzzler. I've sold it based on your trading strategies.
I was going to say maybe I should do my own advice, seeing as I live in Silverstone. But the thing is also what's been interesting. So this week, Shell's own CEO basically put a bit of confirmation on our own thesis that we come up with independently, stating, I'm reading here straight off my page, energy shortages could hit Europe from April. Jet fuel is already short in parts of Asia, and diesel and gasoline will be the next issues. So this is not tinfoil hat kind of stuff.
Yeah.
These are genuine risks that I don't think the market is pricing for at the moment.
Yeah.
And I think that's the key thing from our job. It's like, it's not going like, oh, things have already come down next. It's actually, we need to find the dislocations of things.
Yeah.
And I think at the moment, the market's been a little bit optimistic this week with things. But anyway, so sold down that, moved into US Treasury inflated protected securities, basically the same as our index-linked gilt market, but US. The reason for that is because the UK/European market is too small to be targeting specific durations.
Yep.
Whereas in the US, I can buy 0 to 5 year tips. So I can buy the short end, which means it's not so much a heavy duration play, but more of it just a pure pure inflation trade. So just looking straight in front of me. So bear in mind, we held some tips beforehand for this reason, because it looks quite attractive. So I did have it literally right in front of me. Yep. So Euro govs are down 2.67%. The tips are down just 0.29%. So, that thesis that we had previously is playing out.
Yeah.
And I think this is going to continue.
Yeah. But this is the one that's either going to make you look good or bad. So
I mean,
it's probably the same.
At the moment,
go with conviction.
I have a good track record at the moment, so let's try to keep this going. But so there's certainly one to review on our highlights reel at the end of the year.
Yeah, viewers can
bring on the Christmas special.
Comment on the Christmas one, exactly. But I think more important, it's nothing. We hopefully demonstrate that we are being active,
and forward thinking,
trying to put these things into play. It's very easy to sit there thinking, I wish I'd done this, I wish I'd done that. I think we have a good in-house mentality that we're also not rash and sort of jump on a thing the first time. Like I always, like gold. I think the third, maybe even the fourth feeling that we're getting, like, we've already had discussions sort of, it's gone below 5 or 4. I think it only needs a couple more of those, and we'll find a good point. And I think that's why these topics keep needing to be debated and revisited. And I know on euros, I just let you were.
I think the key thing to point out on gold, though, as much as we're saying it wasn't the first time out, it was frustrating because it was actually a trade that we noticed in Feb 24, because gold had come off quite a bit at the end of 23. Unfortunately, when we wanted to put the trade through, it literally just started picking up again. And obviously it's been up until until literally 2 years, a 24-month rally. Yeah. So trying to find a buy-in point was never a good, easy thing to do.
It's easy in hindsight, but I was feeling it was bubble. Like, when something's going 8% up in a day, not really knowing why, then it would have been too emotive to have chased that one, I think.
The other thing I want to reaffirm is that we've gone through since we put these, because obviously since we recorded last week's episode, we've had quite a lot of news trade. There was a bit of a relief rally Monday, kind of Tuesday, going through. So we have put all of these trades back through our scenario analysis, etc., and they still hold. Yeah. So, but key thing to point out here is these aren't reactionary. This is very much forward looking.
Yeah.
I think that's a key thing to point out.
Yeah, which, as I say, I think is worth. I mean, we joked about Christmas there, but no, we'll sort of do a summer review, perhaps of these
during the quiet period in August.
Don't think there's ever. Well, yeah.
News flow goes a bit quiet.
News flow quiet. Yeah. Not business quiet, but no, good. Keen to keep these to about half an hour, Sam. So I think that's been really, really good from my side. Hopefully that will be really, really useful for our advisors, I think, as well. I know we've got a mixed audience on these, but anyone that has any questions, please do come back on these. As I say, been quite direct with actual ideas that we've done in house. So again, hopefully useful and another source of validation for clients around how their money's managed and the care and attention that Sam always takes. As ever, would love to have some feedback, but otherwise I think that's another good episode bagged. And we'll be back next week.
Catch you next week.
Thanks, guys. Bye.